Welcome to the Deep Dive. We're here to break down the big financial reports that really shape the infrastructure powering our digital world and make sense of it for you. Today, we're going right into, well, the engine room, you could say, the data center platform. We're looking at the third quarter results, Q3 2025, for one of the biggest global players out there.
Yeah, and this isn't just about spreadsheets and earnings calls. This is really a pulse check on the whole AI revolution, isn't it? Data centers are, the bedrock for all this stuff. These results show us how fast things are moving and, critically, where the new capacity is being built. We need to get past just the headline numbers and really unpack what they mean strategically, especially with AI demand just exploding.
Absolutely. So our mission today is pretty straightforward. We're focusing on three main things in these results. First, the record financial performance and how predictable their future looks. Second, the huge amount of money they're pouring into development, especially for AI. And third, their role in sustainability, which is becoming, well, non-negotiable. We want to cut through the jargon for you.
Okay, let's kick off with those financials then. They really set the stage. The key metric for real estate investment trusts, or REITs, like this one, is funds from operations FFO. Specifically, their core FFO per share hit a record $1.89.
$1.89. And that's up significantly from, what, $1.67 in the same quarter last year, Q3 2024.
Exactly. A big jump shows strong performance.
That points to efficiency, good rental growth. But what about the pipeline? What's coming next? Total bookings, that's new contracts signed, at their 100% share hit $201 million. And overall revenue, up 10% year over year, that's $1.6 billion total revenue.
Yeah, 10% on that kind of base is, well, it's pretty impressive. It tells you there just isn't enough high-quality data center space out there. If you're a big cloud company or doing serious AI work, you need this capacity now. Achieving double-digit growth when you're already this big, it means the market is definitely not saturated. Not even close.
Right. Let's talk about the scale first, because that's a massive advantage in this game. They operate 311 data centers, 311 across over 50 major cities worldwide. That physical presence is one thing.
It is. But the real stability, the predictability, comes from the revenue that's already locked in but hasn't started yet. We call that the backlog. Specifically, signed but not commenced leases. These are deals fully signed, legally binding, but the customer maybe hasn't moved in yet or the building's still under construction.
Okay, and this is where you get that visibility right. The number is $852 million in annualized rent.
$852 million. And think about this. That represents more than 20% of their current annual rent.
Wow. Over a fifth of their existing business is already booked for the future.
Precisely. That takes a lot of the risk out of planning future builds. It gives investors confidence. And these aren't just potential deals, remember. They're signed contracts. What's even better is the timing. Yeah. They expect 85% of that $852 million to actually start generating revenue through 2026, so pretty soon.
Okay, so the demand is locked in. But building these things costs a fortune. How's their financial position to actually fund all this?
It looks extremely strong. They finished Q3 with about $7 billion in liquidity. That's cash and available credit, ready for their own corporate spending. But here's the really clever part for the huge projects. They have access to over $15 billion more through joint ventures and investment funds, specifically earmarked for hyperscale development.
Ah, okay. So why use joint ventures, JVs, so much for the really big stuff?
Well, these hyperscale builds, the ones needing, say, 100 megawatts or more, they are incredibly expensive and take a long time. Years sometimes. By using JVs, they bring in partners, maybe big investment funds who share the cost and the risk. It keeps that massive capital requirement off their main balance sheet. So the core company can focus on other things like buying land R&D on cooling and running their very profitable enterprise and connectivity business. It's a smart way to scale big.
Makes sense. The money's there. So what is it building? This is where we really see the AI effect, right? The development pipeline numbers are just huge.
They really are. Right now, globally, they have 730 megawatts MW of capacity actually under construction, but the total future plan, that exceeds 5 gigawatts.
GW, hang on. Let's just register that shift. From megawatts under construction to gigawatts in the future pipeline, 5 gigawatts. Just to give you a sense of scale, 5 GW is roughly the power output of, 5 large nuclear power plants?
Yeah.
Enough for a whole city like Dallas or Philly. And that power is purely for computers.
It underlines the colossal power demands coming from AI, both training the models and running them. But here's the really telling detail. how they're planning to use that future capacity. Over half, 52% of that 5+ GW pipeline is specifically set aside for massive blocks of capacity. We're talking blocks bigger than 100 middle W each.
Right. That 52% figure, that feels like the key signal. They aren't just building more, they're building differently, aimed squarely at the biggest power users, the hyperscalers running the giant AI models.
Exactly. Your typical company might need less than a megawatt, maybe up to 5. When you dedicate more than half your future construction to 100 milliW chunks, you're essentially building dedicated AI factories. And the engineering challenge there is immense. It's not just about plugging things in, it's cooling, it's density.
Which brings us to their innovation lab. They're not just providing space, they're figuring out how to run this next-gen hardware.
Absolutely essential. The Digital Realty Innovation Lab works directly with the tech companies. AMD, Cisco, Lenovo, Supermicro are mentioned. These are the guys making the faster chips, the denser servers. The building has to keep up. Think about moving from air cooling to, say, liquid immersion cooling or direct-to-chip. That changes everything about the data center design, the floors, the power, even the plumbing. They have to integrate these solutions now so those 100 million W blocks are actually feasible when they come online.
And they need places to build them. So they're buying up land now, right? We saw deals in Q3. Land in Los Angeles expected to support 32 milliW. And in Chicago, adding capacity for over 40 milliW more.
That's right. Securing the right locations is critical. You need the power grid access and the network connections. Those are becoming the real bottlenecks. They're locking down prime spots ahead of the curve.
Okay, so we've covered supply, capacity, the build-out. Let's flip to demand and pricing. Who's actually leasing this space? And what kind of pricing power are they seeing? The report gives this interesting split view, doesn't it? The massive hyperscale deals versus their more traditional meeting place business.
Yeah, the meeting place concept is really important. That's their bread and butter, the enterprise market. Smaller customers, lots of them, clustering together in the same facility mainly for the connectivity to connect to each other and to the cloud providers. It provides diversification. They're not solely reliant on, 5 giant customers.
And the numbers show that part of the business is doing really well, too. Smaller users, defined as 0-1 milliW, they booked $64.9 million in new deals. And interconnection, just selling the physical network links, hit a record $19.6 million. Add those up, it's $85 million, which was, 52% of their total bookings for the quarter.
Yeah, 52%. It was actually their second highest quarter ever for that category. So it shows that regular enterprise demand needing that core connectivity is still very strong. It's not going away. The sheer number of connections in their buildings, over 231,000 cross-connects, now proves they are the central hub for thousands of businesses.
So that's the diverse high-volume side. But the real test of market heat often comes when leases expire, right? Renewals. What did the cash renewal spreads look like? How much more are tenants paying when they re-up?
Okay, the cash renewal spread just compares the new rent to the old rent on a cash basis. Overall, across the whole portfolio, renewals saw an 8.0% increase in cash rent, which is solid. That's on a base of $192 million in annual rent that got renewed in the quarter.
8% average is good, very healthy. But I saw a number in there specific to the big guys, the ones needing over a megawatt, likely including those AI workloads.
Yes, that number jumps out. For that specific segment, the larger capacity leases, greater than 1 milliW, the cash rental rate increase on renewals was 19.9%.
19.9%. Almost 20% higher rent just to stay put for those big tenants.
It's exceptionally strong. It signals really intense demand for that specific type of large-scale capacity.
That's almost textbook inelastic demand, isn't it? The big cloud and AI players, they need that space. They need it now, and they're willing to pay a significant premium. Because delaying their AI rollouts probably costs them way more than a 20% rent hike.
That's absolutely the dynamic right now. But, here's the question for you listening. Can that 20% increase continue indefinitely? That kind of pricing suggests a major capacity shortage, which is great for the landlord now. But it also maybe incentivizes those big customers to eventually build more themselves or look harder at alternative providers or regions. For this moment, though, these results show they have significant leverage thanks to their scale and existing infrastructure.
Okay, we've hit the financials, the AI-driven expansion, the pricing power. Let's turn to the last pillar, sustainability, which, frankly, when you're planning to build gigawatts of power demand, isn't really optional anymore, is it? It's core to the business.
Absolutely. You can't operate at this scale without a serious energy strategy. They're actively positioning themselves as a leader here, calling themselves the leading data center partner for sustainability. And they back it up with metrics. Globally, they report using 75% renewable energy.
And that's not just a goal, right? They have contracts in place.
Yes, 1.7 gigawatts of contracted renewable capacity. They are actively buying renewable energy to match their consumption in major markets. We're talking 185 of their sites are matched with 100% renewables. That includes all of Europe, plus key U.S. markets like New Jersey, Texas, San Francisco, and also Sydney. This is critical because their biggest customers, the hyperscalers, have their own huge carbon reduction targets. They need their suppliers, like the data center provider, to be clean. It affects their Scope 3 emissions.
And it goes beyond just buying green power. They're also focused on efficiency in the buildings themselves.
Right. They lead the industry in having the most IT capacity certified by green building standards. They even won the Energy Star Partner of the Year award. Operationally, almost 70%, 69% of their U.S. portfolio is Energy Star certified. But what's maybe most interesting is how they've tied this into their funding. They basically pioneered green bonds in the data center world.
Green bonds. They've issued $7.2 billion worth. For listeners, what does that actually mean, a green bond in this context?
It means the money raised from selling those bonds is specifically earmarked ring-fenced, you could say, just for projects that meet certain environmental criteria. So things like funding renewable energy projects or constructing new, highly efficient buildings that achieve certifications. It directly links their financing to their sustainability goals. It attracts investors who specifically want to fund green projects, and it sends a strong signal to customers about their long-term commitment. It's smart finance aligning with their mission. Hashtag TAC Outremedo.
All right, so let's bring it all together. What have we seen in this deep dive today? Record core FFO, showing strong current financials, a huge $852 million backlog, giving great future visibility, a really clear strategic shift towards AI, dedicating over half of a massive 5 GW future pipeline to those 100-plus MW blocks, and serious market power, shown by that nearly 20% rent increase on large renewals. All of this supported by a real measurable commitment to sustainability.
Yeah, the core elements scale, connectivity, the ability to deliver specialized high power capacity, they're all firing. The market fundamentals look incredibly strong for them right now, and you see that confidence reflected in their own actions. They actually raised their forecast for the full year 2025 core FFO per share. The new range is $7.32 to $7.38. That tells you management believes this momentum is going to continue.
Okay, so here's the final thought we want to leave you with. The data we looked at today clearly shows AI is the dominant force driving this infrastructure build-out. Demand for huge power blocks is accelerating. Now, if the industry is pivoting this hard towards needing gigawatts upon gigawatts of power, think about that 5 GW pipeline just for this one company. What does that imply about the real long-term constraints? Is the ultimate bottleneck going to be the silicon chips? Or is it going to be the physical world limitations? Generating enough power, transmitting it, finding enough water for cooling for these enormous 100 milliW plus AI factories that are coming online.
That's the multi-trillion-dollar question hanging over the next decade, isn't it? Where do those physical limits kick in? Something to chew on. That's it for this deep dive. Thanks for joining us.